Okay, guys, once more, you are welcome to CryptoZilla YouTube channel. Today, we'll be talking about futures trading. But before we dive into that, I would want you to please follow this video to the very end so you can get the detailed info about what futures trading is all about. And as well, you get to learn how to place your orders without a liquidation price so you don't get liquidated. So these are other things you have to learn if you follow up this video to the very end. And also, do well to subscribe and click on the like button so you get notified whenever we drop similar videos like this to get you enlightened about what the crypto space is all about. Now, let's dive straight into it. Futures trading is nothing else but just an agreement to buy or sell an asset at a set price at a predetermined date in the future. Now, the buyer must buy these assets and the seller must sell these assets at that price at a predetermined date in the future, irrespective of what the current market price is then. So basically, in futures trading, you are either making a purchase in the future or selling an asset in the future, and having reached an agreement today to buy an asset at a certain price, which the transaction must hold in the future. In this video, I'm going to actually tell you guys, explain now what the future trading really entails. For example, let's say if you take a look at your Binance, and let's go to the interface, this homepage interface. If you take a look at what the price is here now on, let's, for example, your Bitcoin here, what the price is 2821. Let's take note of that, 2824. Go to futures. You're having 28873. Let's go back. Here you have 28825. Here you have 28876. Are you seeing that there's a slight difference in the price? So actually, it seems the future is actually faster in price. The future is following what is happening on the spot trading. This is the main price of here. Why this has already happened? This has already happened here. So it's going down to this. Now will go down to what is showing here already. So basically, the futures trading is keying into what the market will look like in the future. It's following the main market price at the back. So there's a little difference between the market price and what the futures trading price is all about. Now, in a layman's term, let me explain to you or draw a picture of what the future trading is all about. Now, for example, assuming I, Mr. A, wants to actually purchase something, let's say a phone, let's say in every June of every year, we get to understand, like for an example, at the 6th month of every year, let's say a particular asset tends to increase in value. Let's say a phone, for an example, tends to increase in value. It's known that at the particular month of the year, let's say the 6th month, which is June, a particular asset tends to increase in price. And I actually want to buy it now as against then. I want to pay for that goods now because I need the phone in June. Now, let's say this month is May. I, Mr. A, will approach Mr. B, who is the seller. I will say, okay, Mr. B, please, I want to buy a phone in June from your hand, but now I want to pay for what the price is now, and I don't need this phone now. I want to get it in June. So I'll actually pay for the price of this phone, what the price is now, which is say 20,000 naira now. And let's say in June, the price tends to increase by 25,000. Now, if I pay for the goods now, which is 20,000, I enter a long position at the moment into the market. Then whatever the price be in June, I must get that phone from the seller. Now, let's say we get to June and that price increases, the price of the phone increases by 25,000. The seller must have to deliver to me. That means I'm making a profit of 5,000 because at that moment I can still sell back I can still close my position at that moment, sell back. If I close my position in June, that means I'm selling my position back to make 5,000 naira. Now, let's say, assuming in June, the price of the phone is no longer 20,000. It tends to fall back to, let's say, 10,000. That means my long position has been cleared off by 50%. It's no longer 20,000, but I'm now buying it 10,000. Though I've already paid 20,000 to the market already. I don't queue into the market before it gets to that point. So whatever the price be at that moment, the transaction must actually be executed. So that is how the futures trading actually works in a layman's term. So on this tutorial, I will be covering some major aspects of futures trading, so key terms and some things you get to know about why trading futures. Now, the very first is margin. I'll talk about margin, I'll talk about leverage, I'll talk about liquidation price, isolated margin, cross margin, your take profit, stop loss, long and short, mark price, and entry price, one-way mode, hedge mode, how to place an order, and how to close a position. And at the end of the video, I will actually teach you how to actually create an order without a liquidation price. So the order can actually run as long as you wish without your account getting liquidated. Now, let's give this a headshot. Let's go into explaining each and every one of these terms to actually make you understand what they stand for and how they function on the futures trading interface. Now, for the very first one, which is margin. Margin is nothing else but the amount of money that you must deposit and keep at hand with your broker. So when you open a position, that is the money you actually deposit. Let's say you are buying into the position, you are buying some positions in the market. The particular amount of money you used to buy that position is said to be your margin. Now, it's not a down payment. You do not own an underlying asset. What you just did is to queue into the market. You actually took a position, but it doesn't have an underlying asset yet. Now, the leverage part is just the ability to control a large contract value with a relatively small amount of capital in the futures market. The capital is called the performance board or initial margin. Now, let me show you a little thing. For example, I'm on a trade here, a little trade. Let me use this dashboard to explain that. This is the very first one I explained, which is the margin. This is the margin. The amount I use in entering this trade is $9.64. Now, the leverage, like I mentioned earlier, I said is the ability to control a large contract value with a relatively small amount of capital. Now, if you observe here, I'm using $9.64 to purchase this size of Bitcoin, which is 0.005. 0.005 in actual sense, the actual value in Bitcoin should be up to, let's say, should be up to $400 to $500 or thereabout. But I'm using $9 to actually control this size of Bitcoin. So that is enabled by the leverage I'm using. I'm using 15x. If I use 20x here, then this amount of Bitcoin will be increased. Now, to also explain to you, or for you to actually understand what you stand to gain and what you stand to lose with the size of leverage you use, you should check a video. There's a video I created. You should check this channel. There's a video I created on risk-reward ratio that helps you to calculate the amount of profit or loss you incur if the market goes in your favor or against you in respect to the leverage you actually used. Now, the liquidation price. The liquidation price is actually the price at which your margin drops to zero. In a layman's term, it actually means the price at which your margin is exhausted, getting you bankrupt or rather closing your position on the market. Now, this is the liquidation price. It actually means that if the market price here falls or increases to 38.20, this margin will be liquidated automatically. I will lose it all. Now, I'm on a short trade here. This is where I enter entry price. The mark price is 28.71. Now, if the price increases to 38.20, I will lose this amount of money I use in entering it. That means this money will vanish and this trade will automatically close. So the next is the isolated mode. Now, if you move up here, before you enter your trade, you click on this bar here, you see isolated and your crossed margin or mode. On the isolated mode now is actually the margin balance allocated to an individual position, which allows you to actually manage the risks in that positions. Now, what it actually means is this. Uh, on this trade here that is running, I'm on isolated mode. Now, if I exhaust this, I will only lose this. This is the only margin or capital that that I wanted to enter with on this position. Since it's on isolated mode, I only have to risk this amount. But if it's on a cross margin, which is supposed to be the next thing I'm going to talk about, if it's on a cross margin here, click on cross margin. Okay, I'm on a trade, it won't navigate. But if it's on a cross margin, if I exhaust this amount here, let's say the market goes against me and I exhaust this amount here, the market will tend to uh, take more margin from the balance, the total balance I have at this point. So that is how the futures actually work. Now on TP and your stop loss, the TP here, if while setting your market, is always advisable you put at your TP and your stop loss. Now, if you put your TP, it's always be at that price where the market will close if you've actually made profit for you to take your profit. While your stop loss actually helps to mitigate your loss. If the market is against you and you don't want to lose more, you have a stop loss. Once the price gets price gets triggered, it will actually close the trade for you. It will only get triggered when the price has been touched or that market has actually gotten to that price level. So that is actually how the take profit and the stop loss actually works. Now the long and short actually means the long means you key into the market. You are actually predicting that the market from that point where you've actually bought will go up. Now, the very first thing, the very narration I gave to you guys when I talked about purchasing a phone in May. Now, let's assume now I don't understand. I know that in June the the price of this phone is going to be above 20,000, and in May I already know that the price of the phone is in May is 20,000. In June, I expect it to be above 20,000. Then I can give the money to the seller or whoever has it. I say, okay, take 20,000 naira. I expect you to give me this phone, regardless of what the price is in June. Then at that point, I've actually longed the position. That is long. Now, whatever the price becomes in June is none of my business. The buyer or the seller must give it to me. If in June the price of the phone is no longer 20,000, it's 25,000, it's not my business. The buyer must have to deliver to me. But at that case, if I decide to sell back to whoever I want to sell back or request a balance of 5,000 naira with the 20,000, making 25,000, meaning I have made profit from that trade. But if the price of the phone in June is no longer 20,000, but have dropped from 20 down to, let's say, 5,000, that means I am losing that position. And at that point, I'm losing some amount of money. Now, on the short side, short actually means you are predicting a fall in price of an asset. That means you are going short. You are assuming that you're actually predicting that the price of this asset is going down. You are shorting your positions. So that is just the basic difference between your long and short position. Then the mark price simply means the market price here, while the entering price means the price at which you enter the market, which is here. Now, how to place an order on futures. Now, before you place your order on futures, it's expected that you should know technical analysis. You should know the price at which you want to enter, and you should understand that basically there are what we call order blocks if you want to trade with the market, rather, where there are order blocks. You should know at this point, these critical points where you should queue into the market. For example, This is not advisable, but if you want to do that, it's left for you. Now, for example, if you watch this 28,600, 28,500 here, there is having about 1.330K. Here is having about 1.26K. That is above 1 million naira. This is just an order block. If you want to key in into here, for example, what you need to do is to actually tap on the price. The price will reflect here. What is the amount of your asset you want to key in? Let's say 50, this 25% or 50% of it. Then you queue your price, which your price is already here. You set your take profit and you set your stop loss here. Then you can go long. You join the market here. Or if you want to actually go short on this market, what you need to do, if you want to trade with the other blocks, this is scalping. You are not actually following market analysis, or you're not doing any technical analysis. It's not advisable, but few times it plays out. You scalp the market and you make a little profit out of it. But if you have a trading strategy, if you are good in technical analysis, you can actually do your own analysis, come up with a price you want to buy at, then queue into the market as well. But if you want to short using the other blocks here present, here they are having almost the same. I can queue in into 29,500 here. 29,400. I will set the amount of USDT I want to buy, which is 50%. Then I'll choose my leverage here. You choose your leverage wisely. Remember, they will always tell you, selecting higher leverage such as 10x increases your liquidation risk. Always manage your risk levels so okay, they say see our help article for more information. So there's actually a warning there for you to actually mind your size of leverage so you don't get liquidated fast. Now, the size of leverage actually determines how fast you make profit and how fast you make loss. So if you are good in risk management, you should know that it's better you make a little profit than losing even $1 from your balance. That is the rules that guides this game. But you shouldn't go greedy as a beginner till you master your technical analysis and you know how to follow this market properly. So that is just it. The leverage actually determines your profit and your loss. So now, how to place this order, which I was explaining, you've already chosen your market price here. You've taken 50%. Now, you set your take profit price and you set your stop loss here. If you want to go long, you click on go long. And this order here will be placed on open orders till the price is get filled up. Your position is get filled up. It will appear somewhere here to show you your unrealized profit amount minus 0.0203 here, which is 0.25% of what I'm having here. So that is just it. Now the entering price is reflecting the market price, and this is my liquidation price. And I'm risking about 6%. So that is it. Now, back to what I actually promised to tell you guys, how to actually enter a trade without having a liquidation price. Now, it's very simple to do that. Now, let me close this order to use this balance to show you what I mean. I'm closing this order now. Now, here I have a balance of 10 USDT here. I'm using this for tutorials. Now, if I want to enter a trade without a liquidation price, now I don't enter a trade with above 30% of my account balance. Here I have 10.12 USDT. So all I need to enter this market is 3 USDT. Now let me click on here. 50% of this is 5. I will have to reduce it to 3 USDT. I have to reduce it to 3 USDT or below. Let me do it at 2.94. Then my leverage will be at nothing above 5x. Let's say 4x here. Then I will have to, let's say I'm going long. Okay, let me choose this so it will be executed fast. Let me click on long. Okay, let me click on not long. I'm choosing 2.81 and let me use 33.12. So the basic thing is it should be on a crossed mode. Your trade mode here should be on cross. Your leverage should be on nothing less than nothing above 5x. I'm using 4x now. Then I'm using $3 or below. Since $3 is the 30% of 10, so I'm using 2.93 now. Let me reduce it again. Okay, let me open a long position. Must be 0. See, that won't let me. But the basic thing is, let me open a long position. They won't allow me. Let me increase it. Okay, I think I need to fund this account. So guys, I have to fund these accounts so I can actually demonstrate to you how to set a trade without a liquidation price. Now, here I have 60 USDT. The rule is this: I don't enter a trade with anything above 30% of my balance. So all my trades, all the positions I will open will actually be within the 30%. Now, assuming I want to enter a trade here now, I want to enter a random, I want to actually queue in a random position here without any analysis, just to demonstrate this to you guys. Now, 30% of 60 USDT, let's do a little calculation. 30% times 60, it should be $18. So all my trades should be within $18. It won't be above $18. So I'll go back. I will choose, okay, here is $15 already. Then I want to go for a long position. Click on long. Remember, your mode should be on cross. Then this is it. It's running. There's no liquidation price here. So that is it, guys. Remember to actually subscribe to this channel. As well, turn on the notification icon so you get notified whenever we upload videos like this to get you enlightened on how the Binance trading or futures trading actually works. We also make videos on earning opportunities online. We have a Telegram channel where you can actually follow market updates. We also have a WhatsApp group where we drop free signals and all that. You check the description of this video, you'll find all that link so you can join up and take advantage of our free signals and follow up market updates on a daily. So thank you guys for actually following up this and watching to this very end.